How does owner financing work in real estate? This is a great question because the answer can set you free. It can even be necessary for your next deal, especially if you're having issues with qualifying for a loan or if you'd just rather not deal with banks. Because they're certainly not required, and I'm going to show you how. You ready? Let's go. So by the time we're done here, you'll know what owner financing is, how it works, and how to set it up for yourself. And at the end, I'll also give you a free copy of my owner finance contract so you can reduce your risks and make better buys. So if you're in the market for a new home or your next investment property and are perhaps having trouble winning loan pre-approval, or maybe the thought of jumping through the hoops that banks put you through to get an approval has you a little bit discouraged. I totally get it. Well, owner financing is an alternative that can keep this dream alive. Though not all sellers will be willing or able to provide direct financing to the buyer, it can be an excellent way to buy a property while also simplifying the closing process, even cheaper. You see, unlike dealing with a traditional bank, when it's their way or the highway, that's how they run their show over there, owner financing lends itself to an almost unlimited amount of flexibility and creativity. And in some cases, it can become very complex, but it also doesn't have to be. Either way, it's important to understand the process before signing on the dotted line. So let's start with defining what it is real quickly. Owner financing, also known as seller financing, lets buyers pay for a new home without relying on a traditional bank or a traditional mortgage. Instead, the owner finances the purchase. Just like a conventional mortgage, owner financing will typically involve making a down payment on a property and then paying the balance off over time. It's like an IOU from the buyer to the seller. So this alternative to traditional financing offers a lot in the way of flexibility. For example, owner financing is typically more expensive and requires repayment or refinancing into a traditional loan in as little as 5 years. That's what most real estate agents will tell their buyers and sellers. But understand this, everything is negotiable. As long as the seller and the buyer agrees, anything goes. Some sellers may require some form of a background or credit check, and some don't. Most don't, actually. Further, there are no banks or traditional lenders involved, and so an inspection or appraisal, those aren't required either, unless the buyer wants them. Now, once a buyer and a seller agree to the terms, monthly payments are made to the owner-seller according to an agreed-upon amortization schedule. Unlike traditional mortgages, tax and insurance payments generally are not rolled into the monthly payment, and the buyer must make those payments directly. Other than that, everything else about the real estate transaction is the same as any other. Instead of making payments to a bank, you're making them to a seller. And then, just like every transaction, after you've made your final payment to the seller, the mortgage lien is released and you own the property free and clear. Now, there are some advantages and disadvantages of owner financing, and I'm going to get to those next. But if you like making money in real estate, let me know by smashing the like button. And if you take your real estate investing seriously, subscribe to the channel because I share money making and money saving stuff like this each and every week, and you don't want to miss it. Now, owner financing, this is a popular option for borrowers because it can be much easier than dealing with a bank. Sellers might opt for owner financing to expedite the closing process and collect interest rather than taking a lump sum payment. Still, there are some disadvantages that may prevent a buyer or seller from signing on for owner financing. First, the advantages for buyers. Owner financing can provide access to financing that a borrower may not otherwise have qualified for. Owner financing enables buyers to finance homes that don't qualify for conventional financing. It also reduces the cost of closing by eliminating appraisal costs, bank fees, and if the buyer so chooses, inspection costs. Owner financing also offers greater flexibility to getting the deal done. Now, second, the advantages for the seller. Owner financing, what this does, it allows them to sell their property as is without having to meet a lender's appraisal requirements. It also presents an investment opportunity with better returns than most traditional investments. And it can shorten and simplify the selling process by eliminating the traditional lending process. Owner financing can spread out their tax liability over time, and it offers the ability to sell the promissory note to an investor. Now, third, the disadvantages for buyers. Owner financing may require the buyer to make a balloon payment at the end of the loan term. But that's about it for the buyer. I mean, you could look at it just more of a stepping stone to a more permanent situation. Now, the disadvantages for sellers, owner financing can expose the seller to the risk of non-payment, subsequent default, and in some cases, a need to initiate the foreclosure process. But as a seller, I actually see this as a good thing because the seller gets their property back, They get to keep all the past payments, the down payment and the monthly payments. They get to keep whatever improvements the buyer made to the property, and they get to keep all of that. And then they get to sell it all over again. Owner financing also could put the seller on the hook for repairs and other consequences of deferred maintenance if the buyer defaults. But that's just part of real estate. And much of the real estate horror stories that you may hear from others, that can all be mitigated by just good upfront due diligence. Now, in just a second, I'm gonna give you my custom seller finance promissory note. You're absolutely gonna want this if you intend to buy properties with seller financing, and you can have it for free. But let's go over the basic terms that you're gonna need to understand first. Like, for example, the purchase price. So when drafting your seller financing documents, include the total purchase price as a starting point to calculate the terms of the financing. Second thing is down payment. This is the initial payment brought to the closing table by the buyer. If there was an earnest money deposit, this amount should also be included in the agreement. The third is the loan amount. So subtract the down payment, earnest money, and other upfront payments from the purchase price to determine the amount the owner is going to finance. Now, the fourth term is the interest rate. Your agreement should include the interest rate that you're paying to the seller. And in a retail environment, it's likely to be higher than the going bank rates. But know it is 100% negotiable by both parties, as all of these terms are. The loan term and amortization schedule, that will need to be in the document as well. The loan term, this is the amount of time a buyer has to pay back the loan. The amortization schedule shows how much money you pay in principal and interest over time, and will determine our next term, the monthly payment. Make sure your owner financing terms include the number of monthly payments, the due date, and what constitutes a late payment and whether there is a grace period or not. And then balloon payment details. If that's included, many owner financing arrangements are amortized over 30 years, but will have a term that's much shorter. So this results in a balloon payment or a lump sum that must be paid at the end of the loan term. Now, there are federal laws that may restrict balloon payments, so you're gonna wanna look into that for your market. And then the tax and insurance payment. Although taxes and insurance payments are often rolled into traditional mortgages, not typically with owner financing. Nonetheless, your agreement should describe who will be responsible for these payments. And then additional terms. Every real estate deal is different, so make sure your owner financing agreement spells out anything that's unique to your deal. Now, I'll quickly walk you through the steps of setting up an owner finance deal, but if you'd like a copy of my owner finance agreement, you can grab it for free at epicpromissorynote.com, and I'll put a link for you in the description too. Now, there are many ways to put a deal like this together, but I'll give you 3 primary ways to structure owner financing. 1, use a promissory note and mortgage or deed of trust. And this works like a traditional mortgage, or how it would work if you went to a bank. The buyer and seller agree to the terms of the sale and the loan, of which is detailed in the form of a promissory note. The mortgage is secured or collateralized by the house or the property, and the buyer's name goes on the title, and the mortgage is recorded with the local government. Again, you can grab a free copy of the promissory note that I use to buy owner finance properties at epicpromissorynote.com. The second way is you could use a contract for deed, also known as an installment sale or land contract. And this is when a buyer does not receive the deed to the owner finance property until after they make the final loan payment. Just like, when you buy a car, works the same way. And then the third way is to create a lease purchase agreement. So this option, also referred to as rent to own or lease option, involves a seller leasing a property to a buyer who has the option to buy it for a set price. So the buyer pays rent for the lease term, and at the end of the term, the buyer has the option to purchase the property for the predetermined price or just walk away. If the buyer opts to buy, a portion or all of the rent that was paid during the lease period is applied toward the purchase price. Now you know how to owner finance real estate. Oh, and by the way, if you'd like to dive in and make some quick money in real estate and flip a house in just one day while using my funds to do it, I'm gonna give you my funds to do it. I'm gonna show you how you can pull this off in your market right now at mattsfreetraining.com. Alrighty, that's all for now. Thanks for watching, and I'll see you next time.